Insurance, this is Tony Cañas. Today, I want to talk to you about incentives. People do what you pay them to do. That is a much deeper phrase than it might appear at first glance. You have to be very careful what you measure. People do what you measure. You have to be very careful what you incentivize, because people do what you incentivize. This makes a ton of sense intuitively. The problem is, unless you pay careful attention, there's a good chance that you're measuring and incentivizing and pay people for the wrong things. I started understanding a little bit about this in my undergrad. My professor for accounting 184, the very first day of class, she said, people do what you pay them for. And it seemed the most asinine comment. Obviously people do what you pay them for. And then she went deeper into it. The problem is you might not be measuring the right things. And she gave an example of how herself, as a professor at Iowa State University, she had two ways of printing an exam. One way was just printing, 400 copies of the exam. Another way, which was better for the university because it was cheaper, was printing one copy and photocopying it 399 times. Her activity was largely defined by the way they measured it. So it turned out that they measured how many photocopies she made in a given semester, and that was restricted. She only had a certain number of photocopies for the semester that she was allowed. But they did not measure how many pages she printed on the more expensive laser printers. Guess what she did? She printed the 400 exams, which was easier for her and didn't count against her number of photocopies. The incentives were set wrong. She should be incentivized, measured, on doing what is right for her employer, which in this case would have been, she should have been measured on the more expensive printouts, not measured or have a much larger number of the cheaper photocopies. And not only that, she should have maybe been incentivized to keep her ratio of photocopies to printout as high as possible, with some sort of award at the end of the year, some sort of bonus at the end of the year for saving the university a bunch of money. The incentives were set wrong. This was very academic until I graduated and I took my first professional job at a transportation company. I dispatched truck drivers for the first 3 years of my career, managing truck drivers. So my job, I was a fleet manager. I had 40 truck drivers that worked for me. I got to decide each and every day where each of them would go. But there's constraints on what you have to do. And the tricky thing here was that I did not have control over the shippers. I was not sales, I was not customer service. The company was divided in such a way that my job was among the load options that the customer service people gave me for each of my drivers, choosing the right one, convincing the driver to agree to it, and then dispatching them. But I didn't have access to the shippers. And I was measured almost entirely on my drivers being happy. At that time, turnover within the transportation industry for drivers was 117%. It took almost 1.2 drivers to keep a truck moving for the year. A lot of the way I was measured was my drivers not quitting, was retention. I was not at all measured on our relationship with the shippers. And then the customer service people were measured in the exact opposite way. They were measured on keeping the shippers happy, not at all on the drivers. By the way, they were commissioned, not by the mile. A driver getting a crappy load that didn't pay enough, took them the wrong way when they were trying to go home or something like that, was not the customer service person's problem. As long as the load got picked up in time and got delivered in time, they didn't care, because they were not paid to care. They weren't measured or incentivized on it. While on the other hand, I had a $500,000, $1,500, $2,000 bonus monthly sitting on my drivers not quitting, being profitable. So what happened? The two departments were at each other's throats at all times. I was fighting tooth and nail with the customer service people each and every time. And every time that I had to make a tough decision where I had to choose, do I defend my driver or do I make sure we're doing the right thing for the shipping company? Ultimately, the right answer for the company is a balance of the two, but I wasn't paid to balance them. I was paid to think of my driver. So you can bet 100% that at any given point, when I had to make a choice, and it happened every day, between the load getting there on time or my driver getting home for the weekend, guess which one won? The incentives were set wrong, pretty much guaranteeing we would be at each other's throats at all times. Then I ended up going into insurance, and I ended up in a claims call center. This unit was called Express Claims. And the way they measured, it was a new department, and the way they measured us in Express Claims was how many calls you took, right? Because we were the inbound, so how many claims you put into the system, that was number one measure, And number two measure is what percentage of those did you keep and work yourself? And you were supposed to keep that percentage above about 25%. Every week, the whole department would get an email with the top of people in the top of the charts for those two numbers. Tony was always on the top of the charts. It was very easy. When the phone rang, the caller ID would tell you whether it was the 800 number or whether it was a direct call to your direct number. If you wanted to be top of the charts in number of claims put into the system, the smart way, because of the incentives, was to ignore the calls coming to your direct number, which are existing claims, and to answer as many as possible of the calls coming into the 800 number. And that's exactly what I did. I basically never answered the phone if it was a direct call to my number. Instead, I changed my voicemail to be like 2 minutes long and give instructions so that the person that with an existing claim that ended up in my voicemail would know exactly what to do. Go to any body shop you want, have them fax me or email me the estimate, and we will move very quickly once you have that. Here's my email, any questions by email right here. That allowed me to be top of the charts each and every week for the entire 14 months I worked there. The other piece was they did not measure claims quality. The thought was that since our authority was only 10,000 because we were the express unit, and there were very simple claims, clear liability, not a total loss, no injury. The thought was there wasn't too much to worry about when it comes to claims quality. I've claimed that closes quickly in less than 10,000 is likely to cost us less than a claim that lasts long. So they were not at all measuring claim quality. They were not doing audits of claim quality. So I didn't worry much about claims quality. My goal was quite simple. I want to pay your claim as quickly as possible for less than $10,000 and have enough in the file that if it does get audited, which it never did, I wouldn't be in trouble. During the exit interview when I left, I was very honest about the failings of the way they were measuring us. And I suggested they should be at the very least taking a good look at claim quality, because right now nobody's looking at that. And they actually hired somebody. I actually know the person that got hired to do that job. And years later we got to chat and he did tell me that my claim files were not the best. You get what you pay them for. Whether they realized it or not, they were paying me to top the charts on the number of new calls answered, number of claims entered in the system, and for closing the files as soon as I possibly could without too much worry about claims quality. So then I went to another company, this time not in the call center, just in claims. And in this company, the way that we were measured was the customer service score was 50% of your overall rating for the year. When they told me that, when I was getting interviewed, I was like, that's exciting. I like that you're measuring that. Right? The previous company wasn't really measuring customer service. I really like that. I think that's important. And then when I showed up, I realized that the way they were measuring it was, we were touching hundreds of claims. There were 5 different adjusters in each claim. 6 to 8 weeks after a claim closed, a third party that they had outsourced to would call the claimant and ask them, how did Tony do in your claim? And they would only do that for 2 claims a month out of hundreds that we touched. And also, because there were multiple people involved in each claim, there was a auto damage person, that there was a rental car person, that there was a recorded interview person, and liability decision person, there was a MedPay person, a PIP person. There were like 5 or 6 people on each claim and nobody specifically in charge. The client just didn't understand, or their insurance experts, they didn't understand what each of the different people got. It would not be unusual for somebody to give you a 1 out of 10 rating, and for that 1 out of 10 rating, then your boss would call them. If they give you a really bad score, your boss would call them, and then they would say something like, oh, the rental car got screwed up. Tony didn't manage the rental car. I would end up with a bad score, and the only way to get rid of that score, my manager would have to convince the other person's manager to accept it, to transfer it over there. They were doing so few of them that they were unrepresentative. And what would happen is, the effect of this would be that you would do your best to give good customer service. And one thing that would happen often, which I never engaged in because I thought it was downright wrong, is trying to manage expectations. Reps would let clients know, especially when they were closing a claim, hey, you might get a call 6 or 8 weeks from now and asking you how I did. If you give me anything less than a 9, that is considered a failing grade. Is there any reason you would give me less than a 9? It just defeated the entire purpose and did not result in good customer service. In July, you get a 1, and you basically mathematically, and you have to be above 9 out of 10. An unworkable standard anyway. And they're measuring so few of them that it's just unrepresentative. So basically what would happen is, if in July you get a 1, you know for a fact next January or next February when you get your yearly review, you're not going to get a good score, because you can't make it up unless you had pure 10s for every other survey they do. So what you would do is you would immediately start looking for another job internally and move departments before that 1 came to bite you in the butt. So again, the incentives were very poorly laid out. The idea was right, but they were not leading to the right results. Those are just 3 examples from my own life, but I've seen it thousands of times. There are so many examples of the incentives just not being set right, and people do what you incent them to do. Keep that in mind. People do what you pay them to do, and unless you're very, very careful and you take a good look at it often, maybe every year, you might be incentivizing the wrong behaviors.